Hi, Dominique, and welcome to another edition of the Week Ahead. We're taping this at the end of definitely a quite busy week. How are you doing?
Still standing and still opinionated.
Yes. So not just, obviously markets are super busy and obviously we were busy, but we had the banking webinar and the webinar also specifically focused on family offices and what we think the risks are. So this isn't just for public markets, but private markets as well. So certainly some very interesting stuff this week. So let's kind of dive right in. Obviously a lot's happened this week. So what were your biggest takeaways over the past week?
So the biggest takeaway is that most of the data we are getting right now is irrelevant because we still have to look for the impact of the crisis on the economic outlook. And my biggest takeaway was, what a surprise. Yeah. The supervision was not as tight as I was thinking. Banking supervision, I mean.
Right. Well, you and Bilal have definitely been focusing on the idea that the economy is strong, the labor market is strong, inflation's not coming down, but the way this ends is the Fed really breaks something. And I guess that seems to be kind of playing out. Now, the question is, as I read somewhere, somebody actually put it quite nice, saying, it's not Lehman, it's Bear Stearns. And I can, I have that personal experience from being at JP Morgan and going to Bear Stearns that next day, and then the market rallying for the next couple of months. What is your feeling and kind of where we are? And obviously, we're in a very different situation for a variety of reasons than we were in 07 and 08. But what's your take on that analogy, I guess?
So my take is that it's not the big one yet, that it's a nasty surprise of the Fed own making for a number of reasons. But fundamentally, banks are nowhere near the situations they were in 2008. With absurd sky-high leverage ratios, short balance sheet, basically. And then the borrower's financial health is also much, much better than in 2008. So there is no comparison in that sense. I think this is much more a liquidity / confidence crisis than a solvency crisis. That's why I don't think it's the crisis that's going to end the expansion.
The big one.
Yeah. But it shows all the limitation of the post-GFC regulatory framework.
Do you see any similarities between this and say, I mean, obviously it was a long time ago, but like something like if you studied like 1987, when we had like crash, you had huge volatility, not just equities, but fixed income, but the market, eventually the economy was able to kind of brush that off.
Yeah, I mean, I think the difference is that in the late 80s, we were moving towards a low rate environment, but this time around, we're really changing regime and moving to high rates. And by the way, let me make a plug for Bilal's Macroscope. It's always a great read, but this week he really explained in very vivid ways, the type of regime change we are going through. And so I would think the consequences of that regime change are going to play out some more in the future. In a way, this is the first step, but the first step, in my view, is not going to kill the expansion.
Right. Okay, so and do you think the market's reacting in the right way? I guess between
people are
equities, but
people are rational. Obviously, fixed income investors are always more worried than equity investors. I think, we all have a tendency to look at the world through the lens of our book.
Right.
In the short term, I think this is a very severe blow to the Fed. But in the longer run, I'm more on the equity side, that this is not the death of, the growth, the very strong growth we have seen, or this is not going to bring disinflation, in my view.
No, and the idea that the narrative that, I mean, you could just see even the biggest banks, including like JP Morgan, where in other times of stress, the stock price would do well because they would be viewed as, benefiting from kind of safe haven status. Most of the big US banks, stock-wise, certainly had a pretty bad week. To me, it seems a little bit surprising. And do you think if just US banks in general are under stress, why would that not significantly impact their lending? And wouldn't that have a fairly immediate effect on the economy?
So that's a key question, but a quick comment on the big banks' stock prices coming under attack. This is irrational. I mean, we can't have capitalism without banks. Those banks are not going to fail. The risk is much more with regional banks and the policy response to try to keep those alive. So that's where, in my view, the irrationality and so the potential for a quick correction is. But for sure, the impact in the macro, through the macro to the macro outlook is going to be through the supply of credit, right?
Yeah.
And there is no question that banks are being shaken and stirred and probably quite traumatized by the price action. And it will have an impact on their ability and willingness to lend. You're going to see probably a tightening of lending criteria. That said, this type of credit crunch is much easier to handle through basically prudential regulation and supervision than a credit crunch that would come from the disappearance of regional banks, because the smaller banks play a key role in supplying credit to small borrowers, mom and pop shops, SMEs that do not have other sources of credit. So, and there have been quite a number of academic studies on that. If they disappear, we're likely to have a credit crunch that will be much more difficult to address than just the banks, getting crazy about giving new loans.
Right, but even if they don't disappear, there's clearly going to be pressure on them to not make anything but the absolute 10 out of 10 loan. I mean, I'm assuming their lending standards are going to go
so
extreme.
I think so. Right now we are in the middle of a crisis, so everything looks unsettled and dangerous. But if you look beyond that, and if you look at the policy response so far, I think clearly the Treasury, the Fed, know about the credit crunch risk as well as we do. And if you look at what they have done with First Republic, for instance, with arranging for big banks to spontaneously, maybe not spontaneously, but just a little bit of nudging, and certainly no explicit guarantee, deposit some money at First Republic for a minimum of 120 days. So this is unusual. Typically, bank rescues are liquidity supply from the Fed. And I think here there were two intent. First, showing that the banking system is strong, it can take care of its own. And second, trying to reverse the flight of deposits from regional to large banks. Because if it continues, the end game is a merger of the regional bank and that really bad credit crunch we were talking about. So I wouldn't discount the policy response. I think the Fed still has a number of things it can do to support regional banks. In my view, one key step would be to guarantee all deposits irrespective of size, since this is anyway what the Fed has done in practice. Doing that would level the playing field between regional and the big four banks and make the regional banks business model viable. I mean, obviously, there would be an offset in terms of a higher FDIC assessment. But, you know, there is a lot that the Fed can still do to contain the crisis.
Right. Okay. So let's, I guess we're not expecting anything to come out this weekend. Unless, I mean, from the government or the Fed.
The First Republic rescue is so public that if it fails, it would be a big problem for the Fed. And that's why I think behind the scenes, they are going to do everything in their power to ensure that the First Republic is still around and maybe still landing next week. And they will.
Yeah, I haven't checked recently, but I saw the stock price was getting hit again. Okay, so and then so going forward for next week, yeah, what are you expecting? And
okay, so it's a bit of a close call because Fed is caught between a rock and a hard place. So on the one hand, the Fed desperately needs to claim that its ability to implement its inflation mandate has not been constrained by financial instability, especially since it bears quite a bit of responsibility, in my view, in this instability. So that would mean hiking. On the other hand, the risk is that if they hike, they could precipitate another crisis of confidence with market participants and depositors thinking the Fed doesn't have our backs. All it wants is to follow its inflation target and ignore everything else. And therefore, it could trigger another bout of deposit flight and panic. So on balance, I'm thinking they do nothing and warn the market that they will do more later, that This is just a transitory, to use their favorite word, a transitory pause.
Get back on them.
A transitory pause. But you know, it's really, my conviction is not strong.
But the ECB going 50, doesn't it make it more likely that, I mean, I forgot which ECB official was saying it, but they said we were concerned if we went 25, the market would take that very negatively, which is surprising because most people thought if they did 50, the market would take it surprisingly negative. And in fact, they did 50 and the markets rallied a lot.
So yeah, the ECB and Larry Summers telling Jay Powell what to do. I think the Fed faces a different situation from the ECB. I mean, as far as we know, there is no pressure, I mean, other than contagion from the US whose stock prices, there is no pressure on Eurozone banks. The ECB hasn't had to establish a facility because the measures taken by the Fed, I cannot stress it enough, are extraordinary. I mean, they are going to give money to banks based on no haircut on collateral, which goes against hundreds of years of central bank wisdom.
Right.
If it goes that far back.
What are they hoping to get by that? It just shores up the balance sheet. I mean, what?
Yeah, because when you think about it, if the banks indeed held the bond to maturity, there is no credit risk. You know, these are government bonds; they would be repaid in full. So in effect, the Fed is bridging the banks' bond portfolio till they can be redeemed.
So these are bonds that they if they mark to market, they could have a 10-15% loss on it.
We don't know because the long end of the curve has been moving quite a lot. But yes, I mean,
but odds are it's down because odds are they bought it like somewhere between 2 and 5 years ago or something. Yeah.
Of course. But so the idea is to reassure markets that even if there is a deposit run, the banks will not be made insolvent by fire sales of their bond portfolio. Fine. And as a result, at least that's what the model predict. Let's see if reality will comply with the model. But as a result, there should not be deposit runs.
Right. I don't know if I saw this right, and I didn't see who. I thought one of the Fed, it can't be a Fed official, but somebody was saying, oh no, Nick Timiraos, I thought said that the Fed is still deciding between 25 and no hike, depending upon market conditions. But like, should they be pushed around by market conditions? Like,
oh, so I mean, look, this is a crisis of their own making. First of all, they waited until no, let me backtrack even more.
yeah.
First of all, after the GFC with Basel III, they basically forced the banks to hold a very large bond portfolio. And in fact, if you look at cash plus bonds, it is now 1/3 of banks' assets, which is crazy. Banks are becoming more utilities.
Who knew that they would then raise rates by 150 basis
so
points?
There is that the regulatory tightening after the GFC was completely inefficient. I mean, the whole resolution of the crisis was terribly inefficient. That's basically what's coming back to bite us. So there was that. Then they waited until they were far behind the curve before starting to hike. So they had to hike very fast. And then even though, you know, the Fed also has supervisory responsibility and is a prominent supervisor among many. I mean, another untold scandal from the GFC is that the US never resolved its complexity when it came to supervision. You have the OCC, you have the FDIC, you have the Fed, you have the states, and God knows how many other cooks in this really poor supervisory broth.
Well said, yeah.
So the third mistake was that even though, you know, supervision and monetary policy are under the same roof at the Fed, somehow the guys who did supervision or who did monetary policy forgot to tap the shoulder of their supervisory colleague and say, hi, rates are actually going up. We were wrong on inflation. So and then I would add another.
Keep an eye on all those bond portfolios we told all the banks to buy.
And then there were a number of flags in terms of SVB. And the Fed has announced official inquiry on what went wrong. But since the Fed was the institution responsible, I don't expect them to make revolutionary findings. I mean, stranger things have happened, but I'm not expecting them this time around.
Right.
So the Fed is in a pickle of its own making, and I don't think there is any good move. It's just next week. It's just picking the move that is least negative. Yeah. And unfortunately, and I share completely Timiraos' view, it means that the Fed has become dependent on markets. So in other words, we have the dreaded financial dominance of monetary policy. The issue is whether it continues or whether the Fed is able to contain the crisis and financial dominance doesn't last.
Yeah. Okay. Awesome. Any data, and I saw you're saying obviously very important. Is there any key data coming out? Is there anything that
it's not on the Bloomberg calendar, actually, because everything that's on the Bloomberg calendar is irrelevant because it's based on the pre-SVB world. I would just single out of the data on existing home sales, because the consensus expects an increase, which would be the first time since January 2022. So it means that before the SVB crisis, the residential real estate market was really mending. But no, the really important data you want to look at is the data on the Fed balance sheet, which will be published on Thursday. Also the data.
That's weekly. It's weekly.
That's a weekly.
You wrote, yeah, so you wrote something on it, right?
Yeah, I have a quick DQT on that. And then the data on commercial banks' balance sheet, which is broken down between small and large banks, which is published today, so on Friday, which is also weekly data. The other thing you want to look at is money market fund data and see if there is a move out of bank deposits into money market fund. We saw a little bit of that last week. So these are the things you want to keep your eyes on, and obviously, the news flow on the deposit flights and
Right.
what happens to First Republic is really important.
Right. Quick one just on that. So, because didn't some of the money market funds blow up? So in this case, people would be moving their money from a deposit account into a money market, which would be in a brokerage account, which would be held separately. Is that?
Yeah, Andrew, there was quite a lot of restrictions put on money market funds.
Oh, okay, fine. Since then,
which for once I agree with. And so what we saw last week was an increase, I believe, of about 120 billion, a little bit more than that, in government money market funds, offset by a small decrease in prime and tax exempt money market funds that are a little bit riskier.
Right.
But basically, the government money market fund is where the money is likely to flow if it
Right.
does.
Okay, awesome. Quick one, I'll just go through some of the pieces from this past week. Obviously, a lot of stuff was around all the banking turmoil. But so Wednesday, Samarjeet did a piece for Prime looking at whether contagion or containment, which obviously that's the key question we're trying to understand. Bilal gave a really good update on this for Prime asset allocation, break down how we think you should be positioned. Having money in cash in this environment is not a terrible thing. But obviously it may be where you hold that cash, which we haven't discussed in the past. Caroline did a nice thing, kind of a postmortem on the ECB and the 50 basis point hike and why there was more there than meets the eye. For our professional clients, as you mentioned, the macroscope, I think it could have even had a better title, but it was an amazing piece that Bilal wrote and released. And I saw that he was calling it, this is definitely a bubble I haven't heard, but in fact, it encompasses all the bubbles that everyone always talks about, which is really, it's a duration bubble.
It's a great piece.
And when you look at tech, crypto, like all these things, it really comes back down to that. So yes, amazing piece. Your piece, which again, people should look at now, I guess it'd be kind of a weekly thing, where you're breaking down the Fed's balance sheet and the movements on the Fed's balance sheet. And then, as we always do, we release the model portfolio. So for our professional clients, please check that out.
The model portfolio is up despite the market turmoil.
Yes, and the model portfolio, I wasn't going to overly toot our horn, but we're still up close to 5% for the year. Was up again this past week, and over the last 2.5 years, and a Sharpe ratio of over 2. So we definitely recommend people to check that out. That's it from my side. I don't know if this was certainly a tricky week, but I feel like we really were proactive in really trying to be there for our clients. The one thing I would say that I was looking on a kind of maybe trade idea of vol, more of kind of a vol trade, is I was obviously in most markets right now, volatility's jumped a lot. I mean, particularly the rate vol. Most safe haven vols have jumped a lot. But I'm looking at gold vol, which is approaching 2000. And that's still like in the middle of the range we've seen over the last kind of 1 to 2 years, which seems like a huge shock. I mean, obviously the skew is for upside, but if people are looking for a play for this kind of uncertainty to continue and looking for safe havens and to play a way to use options, buying upside, I think, on gold can be quite interesting. I would probably target anywhere on the curve, but maybe kind of 2 or 3 month area where vols look like they're around 16.5, 17. So for that, thank you. It was awesome. You know, you were great this week. Got so much good feedback. So
cool. And you know, thank you to all our listeners. And do send in feedback and criticism and ideas, and this is what keeps us going, really.
Absolutely. And it also helps us to continue to improve the product as well. Okay, cool. Awesome. Have a nice weekend. Good luck, everyone.